You're staring at your bank balance at 3 o'clock a.m., doing the same tired math again while somewhere in the world money is quietly working for people who built systems that keep paying long after the work was done. It's 3 a.m., your paycheck disappears into bills, yet invisible financial machines are printing money for ordinary people who set them up once and let them run forever. Imagine waking up tomorrow and seeing money in your account that you didn't trade hours for because some or a system you built kept earning while you slept. You scroll through your bank account late at night, realizing your 40 hours a week barely move the number upward, while others earn quietly from systems built once and running endlessly. Most people trade time for money forever, but a small group builds income streams that continue flowing even when they are resting, traveling, or sleeping. Passive income is not magic, not luck, and not reserved for millionaires. It is simply the result of systems designed to keep generating value long after the initial effort. Somewhere right now, people are earning money without clocking in because their financial systems are quietly working in the background. The truth most people never hear is that passive income is built step by step using clear strategies that anyone can start. Some strategies begin with just $100, while others require larger capital, but they all share one powerful trait. They continue making money whether you show up or not. Understanding how these systems work is the difference between wishing for financial freedom and actually building it. Once you understand the mechanics, you start thinking in assets instead of paychecks. The first strategy is the simplest and most overlooked tool in personal finance. High-yield savings accounts quietly multiply money with almost no effort. Unlike traditional accounts that pay nearly nothing, these accounts can earn around 4 to 5% annually. It sounds small, but over time the compounding effect becomes powerful. Imagine $10,000 sitting in a normal checking account earning 0% for years. After 1 year, the balance remains exactly the same. But the same $10,000 placed in a high-yield savings account earning 5% becomes $10,500 in a single year. That $500 appeared without additional work. Over 10 years, the difference becomes thousands of dollars created purely from smarter placement of cash. The key factor is ensuring the account is insured and secure. Protection such as FDIC insurance covers the first $250,000 if a bank fails. This makes it one of the safest forms of passive income available. The second strategy introduces the power of dividends. Companies often share a portion of their profits with shareholders in the form of dividend payments. Dividend-focused index funds collect many of these companies into one diversified investment. Well-known companies like Starbucks, Pepsi, and McDonald's regularly distribute dividends. Instead of relying only on stock price increases, investors receive regular income. These payments often arrive every quarter like a steady financial rhythm. Typical dividend yields range between 2 and 4% annually. The real power appears when those dividends are reinvested. Reinvesting creates a snowball effect where income begins generating even more income. Over years, the compounding growth becomes dramatic. An investor placing $10,000 in a dividend fund earning 3% receives about $300 annually. If the investment also grows in value, the gains multiply. Over a decade, that investment can nearly double depending on market performance. The third strategy opens the door to real estate without buying property directly. Real estate investment trusts allow investors to own shares in large property portfolios. These portfolios may include apartments, shopping centers, warehouses, hospitals, and office buildings. Instead of managing tenants, investors simply own a slice of the entire system. By law, these trusts distribute most of their taxable income to shareholders. Because of that rule, many REITs offer higher dividend yields than traditional stocks. Yields commonly range from 3 to 6%. Investors receive exposure to real estate income without dealing with repairs or tenants. Liquidity is another advantage because shares can be bought or sold easily on stock exchanges. This makes real estate accessible without the headaches of direct ownership. The fourth strategy is automated investing through robo-advisors. These digital platforms build and manage diversified portfolios automatically. Investors simply answer a few questions about goals, timeline, and risk tolerance. After that, the algorithm allocates money across various low-cost ETFs. The platform continuously rebalances the portfolio to maintain the target strategy. Dividends are reinvested automatically, creating consistent growth. Fees are usually far lower than traditional financial advisors. Many platforms charge roughly 0.25% annually. Over decades, lower fees can preserve a significant portion of returns. This method allows investors to capture market growth without constant decision-making. The fifth strategy involves purchasing an existing business rather than starting one from scratch. Many profitable small businesses operate quietly in local communities. Laundromats, car washes, cleaning services, and pest control companies often generate steady income. These businesses may not be glamorous, but they provide reliable cash flow. Owners eventually retire and sell their operations to new buyers. A buyer can step in, hire a manager, and collect profits while the business continues running. Creative financing options make acquisition possible even without massive upfront capital. Seller financing allows the previous owner to accept payment over time. Small business loans can also support the purchase. With the right management, a simple local business can produce substantial yearly income. Over time, the business may pay for itself while still remaining a valuable asset. The sixth strategy enters the world of startup investing. Online crowdfunding platforms now allow everyday investors to buy equity in early-stage companies. Minimum investments sometimes begin around $100. If a startup grows rapidly or is acquired, the returns can multiply dramatically. However, this path carries significant risk because many startups fail. Investors often diversify by spreading money across multiple startups. A single successful company can sometimes cover losses from several failed ones. This approach represents high risk but also potentially high reward. The most common mistake people make is endless research without action. They analyze opportunities for years but never implement any. Strategy. Meanwhile, time quietly passes and opportunities compound for those who started early. The real transformation begins the moment someone launches their first income system. Even a small step like depositing $1,000 into a high-yield account can start the process. Once passive income appears for the first time, it changes how people think about money. Instead of measuring life in working hours, they begin designing financial systems. Money begins working alongside them rather than being the only reward for labor. This shift in thinking is often more powerful than the money itself. Financial independence grows from consistent systems, not sudden luck. Every strategy begins with a single decision to start. The sooner those systems begin running, the longer they compound. Execution is the bridge between financial dreams and real financial freedom.